it's Kim Darwaza here, your Northern Virginia realtor, and I am back with this week's market update. I took last week off to spend time with family. I hope everyone had a nice, safe, healthy Thanksgiving. And as we round out the end of the year here, affordability is still the buzzword here for real estate. Market's still the same here. Multiple offers on a lot of houses, very low inventory, and the inventory will be decreasing as we come towards the end of the year because a lot of people, don't want to have people coming in and out of their houses during the holidays. So most of the appointments I'm going on now are for the spring market. So we're already getting ready. For instance, today I went to a client's house, helped pick out carpet. They're military, they live in California. He's gonna retire, they're gonna move to Texas. They have a tenant in their property. They're gonna sell that so they can buy. So they're not gonna be here during the whole entire process, and I am going to facilitate that. So today we met with carpeting people. My stager came in, said, okay, we need to paint all these rooms, move this out. Luckily, the tenants are super duper nice and really helpful. So just wanted to let you know we can do this. Even if you are not living here, you have tenants, it still is possible to sell your house. So, an improving economy brings higher interest rates, and the rising yields on government bonds bring higher rates on the 10-year treasury notes, which generally means raising rates for 30-year mortgages. This happened, it could have been because of the information on the vaccines coming out and multiple companies getting them, it looks like, approved by the FDA. And so that's a sign of hopefully we're getting out of this situation soon. Which is good news for businesses, which means once our economy gets better, the rates will start going up, and housing affordability might not be as easy. So now is really the time to make your move. But since instead of rehashing what I've done the past few weeks, I just wanted to do like a case study. And if you're a first-time home buyer, or you have a child who is a first-time home buyer, or people buy properties when their kids go to college, I just want to do a little case study. I have these clients, I don't know if you can see this, and in 7 years ago, in 2013, they purchased their home for $365,000. It's a townhouse in Burke, and we just sold it for $485,000, which basically means if you take what they sold it for versus the purchase price, that's $120,000. But they actually walked away after closing costs with $146,476, and that's after they paid off their mortgage, paid off their closing costs, and the reason for the $20,000 difference there would be when they purchased the house, they did put 5% of their own money in, which is about $18,000, a little over $18,000, and they've been paying down their mortgage over the past 7 years. So not a bad takeaway after 7 years. I mean, they did put in $30,000 in upgrades in that 7-year period. So, you could take that out and say, okay, that's $116,000, and they had put $18,000. But even with paying closing costs on both sides, so when you purchase your house, your closing costs are, depending on your credit, like usually closer to 2% of your sales price. And then closing costs on the back end for them were around $30,000. When you sell, instead of paying closing costs associated with the loan, you're paying taxes, to the county, listing and sales commissions, and so on and so forth. So I would say for a 7-year period to walk away with that much money is not bad. Now, what they did too, which is I sold them this property when just like right before they got married, and they now have 2 kids, and it was like a 3-level small townhouse in Burke, and they decided to move further out, get a house that was 900, it was over 900,000, I want to say like 917 or 13. So basically for their mortgage payment is going up $1,700 a month, which so I think it's like $4,000 a month total now. And they're getting 3 times the square footage, plus a 2-car garage they didn't have before, and a yard for $1,700,000 more. And they basically just took the money from the townhouse, moved it there. They put an earnest money deposit of $10,000 down, and then they paid like an extra $5,000. So they basically took $15,000 more out of pocket from what they previously made to make this upgrade purchase, and they're paying only $1,700 more a month, which I know for younger people sounds like a lot, but when you generally make within 10 years, to 10 years, you're going to make enough money that it's not going to be that big a deal. But anyway, so that is the case study. And if you have questions, I also have one I'm going to do soon too, which is more on a investment property situation. But if you have questions, feel free to call, text, email, private message me, and make sure you go to my YouTube channel and subscribe, because I do a lot of other videos that I don't post on my Facebook. So thanks for watching, and stay healthy, everyone.